My screen, am I controlling my screen or who?
We're
What's
live. I'm controlling the screen. Hey, everybody. This is Scott with the Nest Egg Podcast. Today, we are joined by Kirk Connolly. Kirk comes to us from DCI Solutions, and DCI Solutions is a company that basically helps companies streamline their costs. And the idea here, and I've been working with Kirk for a number of years, and oh, wait, we got to try it again. We didn't go live. Go
it
live.
says? For some reason it says live in the corner there for me.
Here we go. All right, so now it says we're live. Sorry, guys, we had a technical glitch there, but we're live here with Kirk Connolly. Kirk comes to us from DCI Solutions. DCI is a company that helps companies streamline their costs, and met Kirk a number of years ago. When I first heard what he did, I was a little bit suspicious, just because I had never heard of what Kirk did for small businesses. I had heard of it for, big Fortune 500 companies, but never companies that I typically dealt with. And so was super excited once I got to know Kirk a little bit better, and we had spent a couple of months together. I was very excited about what he did, and it's something that I have been doing my best to help business owners find and utilize and make a little bit more money or keep a little bit more money in their business. And so it is the one thing that I do for that we provide to small business owners that I always get the most questions on, and it always seems to be the one thing that escapes people. And so today we have 5 issues that we're going to be discussing, and Kirk is going to review the top things that essentially business owners do that causes them to lose some value in their businesses. So without further ado, Kirk, thanks for coming on. I appreciate you taking the time to spend with us and also the people that we chat with.
Thank you so much. I really appreciate the opportunity, Scott. If I may, I'm going to cover the top 5. I'm going to try and start with a big view for the first 60 seconds and then zero in on what we'll call the first 5, because we'll have many other opportunities, but just to kind of not overwhelm ourselves with too much. So to start at the mile high elevation, what I'd like to do is share my screen. Can everyone see my screen right now? Is it visible to you?
We sure can.
Okay, so just in terms of the executive summary, before we get into the actual examples, this is from dcisolutions.net, so anyone at their convenience can certainly look up our website. And we actually have very specific examples beyond the top 5 that I'm going to share. The first 5, you'll see more of those. So even though it says a company worth 50 million on Monday could be worth 55 on Friday, someone says, well, what happens if my company's worth 10 million? Well, our goal is to make it worth 11 million. Or if your company's worth anything, we're trying to increase the value, the cash flow, the profit by 10%. As it says here, companies of any size realize an average gain of $1,000 to $4,000 per employee. Most companies, you want to give yourself a quiz. How much money does the average company earn per employee? There's all kinds of companies, but if you look at a bell curve, the majority of companies under the bell curve, how much money do they earn per employee per year? Answer. Well, you give your answer, write it down, and I'll tell you what the answer is. The answer is somewhere between $20,000, $30,000, $40,000 in that range. That's the bell curve. You have companies that might be earning closer to $15,000 net earning per employee for very thin margin companies. But just in general, most companies here in America, right around $20,000. So if somebody says, I've got 100 employees, you say, you must have a net profit in your company of about $2 million plus or minus. Is that correct? They'll go, oh my gosh, you're right. How'd you know that? Now, if they're a white collar software firm, you're going to be way off. But I'm talking about just the average blue collar, 100 employees. They make a product of some kind, plastic extruder company, whatever it may be. So when we say $1,000 to $4,000 per employee per year, that's adding, in general, once you get to 2,000, about a 10% increase over where most companies are at 20,000. So going from 20 to 22, that's the 10% jump in cash flow, profit, equity value. That's the value prop put into a form of a picture where we say, if you've got 100 employees, the amount of money that you're losing, once it's stopped, now becomes a gaining instead of a losing. And it translates to 100,000, 400,000. If you want to look at more examples after this conversation, this dashboard, every time you hover over one of the dashboard dials, the needle moves and a different example pops out. 9 different dials, 9 different examples from 9 different types of companies: blue collar, white collar, no collar, privately held, publicly traded, for profit, not for profit, not making profit. It's all covered, represented by one of those entities in the 9 dials. But those entities represent the one thing that all companies, including these companies here, have in common. These companies clearly have nothing in common except that they all have overhead and pay tax. So today we're going to talk about the top 5 ways that your company might be losing money, that if you could reverse that, you would be gaining money. So first, why is this possible? How could this be? I've got a smart CEO, a smart CFO, a smart corporate controller. I've got a great accountant. Plus, I'm friends with Scott Eichler. Given all that's true, how could you possibly say that you could identify savings that I don't know about? Does that sound like a realistic starting point, Scott? Realistic mindset that some of your listeners might have?
That is exactly what we run into all the time.
Okay, great. So we want to look at things realistically. They're saying nobody knows my business better than I do. And I say that is correct. And I know that you know your cost, because you can right now look up AT&T and say, oh, I spent $24,000 on AT&T last year. You know your AT&T cost better than anybody else. That is true. But you do not know your cost drivers better than anyone else. You know what the dollar amount is. It's right there in your G&L, right? You can pull it up, your P&L right now. You can pull up and see, spent $24,000, $61,000, $298,000 on vendor XYZ, whether it's AT&T or Federal Express or any other vendor supplier. You know your cost better, but you do not know your cost drivers better. You do not know what is causing your Southern California Edison or your LA DWP or your PG&E or whatever utility company you're using. You don't know what it is that's causing the kilowatt hours to be as high as they are. You just know what the current cost of those kWh are. And your typical manner of fighting that is to say, everyone turn off the lights when you leave the room. Everyone remember to close the doors on the refrigeration units. Everyone remember to set the thermostats so it's hotter in the summer and cold in the winter. In other words, you do things that make people miserable to save a few pennies, maybe here and there. What we're talking about is not changing suppliers, not cutting corners, not making people miserable, not going to brand X, not telling people that they don't get the bonus or the raise they need for next year, and not having to invest money to save money. So without spending money, without cutting corners, without cutting headcount, without cutting checks, seeing a large, significant reduction in your current cost with the exact same services and the exact same service providers that you already have in place. Those are the ground rules. And because we know cost drivers better than anyone else could possibly be expected to, you don't have to feel like you should point your finger at your CEO, your CFO, or perhaps at yourself and say, boy, if DCI finds all this money, it must mean that I was really not paying attention, or I was careless, or I'm not sufficient. That is the number one reason why you keep losing money, is because if people think you're going to blame someone, or if you think you're going to blame yourself, you're much less likely to learn new things. Does that make sense, Scott?
Yeah, I think that's a great point. So a quick question on this, Kirk. Is it you personally that knows all these cost drivers?
Great point. So DCI is comprised of over 50 former PricewaterhouseCoopers and world-class specialists, all working in one particular category. So for example, in telecommunications, somebody has a large Verizon mobile spend. I think I have perhaps the nation's best Verizon mobile telecommunications analyst, period. Better than anyone inside Verizon, and definitely better motivated than anyone inside Verizon to reduce the claims. So that person will pull out a spreadsheet with 12, 14 tabs, identifying down to the individual penny per device where money is saved, and then compile it into a full printout where the client says, oh my gosh, we just did a review on this, literally, this, speaking of one particular company, we just did a review of this and we thought we got everything. And now you're saying that there's an extra $100,000 in our Verizon mobile that we didn't already know about? Yep, right here. Here's how it works. Here's how you can execute it. And here's all the spreadsheets that prove it if you want the annotations down to the most granular minutia, right? So this allows us to do things that are fairly astounding. Is Kirk the expert? No. Kirk is not the expert in mobile telecom. He's not the expert in LTL freight. He's not the expert in sales and use tax refunds. This example here is, of course, is a use tax refund for a software company in Southern California. I'm not the expert. I am not the analyst, but I am the expert in experts. That's really my role, because most experts are extremely good at analyzing. They're very bad at communicating. You notice that? Some of the very best type B people who can be heads down in the cubicle, multiple lines of code. When it's time to actually simplify it into 3 sentences, that's where the confusion begins, because they just don't communicate well. So the CEO is typically saying, boil it down for me, make it easy to understand, tell me where to sign, and then show me my money, prove it actually happened. And that's where I tend to step in to be the voice and face explaining these things. And my goal today now is to talk about the first 5 top wasters, things that people are losing money on without even knowing it. So one, you understand that not only is it possible, you will actually be more likely to see the money if you take the pressure off of thinking you've got to do it yourself. Just admit that there are so many blind spots that exist in any complex organization. And as the complexity grows, the blind spots grow, and the depth of the crack in which the money falls is deeper and holds more money than, say, a company with just 3 or 4 people. Okay.
So let me just recap here real quick, Kirk. So what you're saying is, in any given company, the reason that the owners don't know, the basically the value they're using is that the subject inside of something, let's say telecom, is so broad and so deep that not only do they not know, the people inside Verizon often don't know.
Exactly.
And you're finding experts and bringing experts to the table that allow them to go, and that expert is niched to that one specific area, and they go very deep, but their knowledge is very narrow but very deep.
Right. Yeah.
And your benefit, Kirk, your benefit is you're good at finding all these deep people, and then also helping them communicate to the CEO. Here's the value proposition.
Right. We try to make it seamless, one holistic solution, so that the clients are not thinking, great, I have to meet 50 different experts. No, you talk to me, and 5 minutes at a time, I might say, all right, we've gone level 1, level 2, level 3, I need to bring in the analyst for a few minutes. And he might come in and talk to the client's CIO or whoever for 5 or 10 minutes on a Zoom call, and then he disappears again. But in terms of relational bandwidth, most people don't have the bandwidth for another set of new faces.
Right.
So I say, here's one face, one voice, one holistic solution that when you look at the top, we usually do 5. When you look at the top 5 most attractive savings in the organization, the net result will be a cumulative $1,000 to $4,000 times however many people you have in your company. So if you told me right now, Kirk, I have 100 employees full-time, W-2, it may be working in one place or a couple different places. I say, great, please expect exactly this much money without reservation. If you've got 100 employees, please expect $100,000, $400,000 of incremental additional money above and beyond. Now, some people say, I know what he's going to talk about. He's going to talk about the ERC. No, I'm not going to talk about the ERC. Oh, he's talking about R&D. No. He's talking about cost seg. No. Well, I'm not talking about any one particular thing, because I know your company's already done this one thing, that one thing, the other one thing. There is no company that hasn't already made some sort of initiative at some point, or has been making multiple initiatives. What I'm saying is, above and beyond whatever it is you've already done and are doing, the additional amount that you don't yet know about and don't yet see inevitably comes to that $1,000 to $4,000 times headcount. That's the law of statistics. It has never failed, no exceptions, not even for smart people like Scott Eichler or his clients. So that's where we start off. Otherwise, why would you want to take this time listening? It would be
makes sense.
You just be taking a 50-50 chance of getting 0. There is not a 50-50 chance of getting 0. There's a 0 chance of getting 0. There's a 100% chance that you will see this much money. Now, whether you take it is up to you. I never tell a client, look, here's a savings on your Verizon, your AT&T, savings on your Bank of America. Here's a savings on your ADP paychecks. Here's a savings on your laundry linen, Alsco supply, whatever it might be. I say, you decide whether or not you want this money. You want this reduction in your cost of Henry Schein products for your practice, your dental medical practice? Great. You'd rather pay more? Free country. It's win-win or nothing at all. So if the client takes no money, He's not under any obligation. But let's get on to the first of the 5.
All right. Wait real quick, Kirk. Hey, guys, if you have any questions for Kirk as we go along, leave them in the comments so that we can ask Kirk along the way. With that being said, Kirk, hit us with the first one.
All right. This is like Pat Benatar said. I don't know if this is my best shot, but I'll hit you with the first shot. How's that? Okay. So there are multiple savings that can be gained on just hiring people. So, for example, I'll say, people say, I get all the tax credits I'm eligible for. I say, well, you're getting the WOTC. They'll say, what's that? And all of a sudden they start writing it down, meaning if you're writing down what I'm telling you, it means you're not getting it or you're not getting anywhere near what you should. But the WOTC allows companies, every time they hire an unemployed veteran, to get up to $9,600, qualified long-term and unemployed people up to $2,400, SNAP, short-term, long-term TANF recipients, people that live in low-income census tracts. So, for example, in California, most of the Central Valley, anything north of North Los Angeles and south of San Jose, throughout the Big Valley, tend to be low-income census tracts. So a lot of employees that are hired there, even if he's got an above-average lifestyle, living in a nice situation financially, if he lives actually in a low-income census tract, then that employer becomes eligible for the work opportunity tax credit. Yes, there are ex-felons. So if someone's been incarcerated, now during the large period of unemployment that our country's gone through, you'll have a lot of people that were unemployed for some period of time, 6 months and a day. You hire that person who's unemployed 6 months and a day previous to taking the job with you, that would automatically qualify the employee, who then, by virtue of you being his employer, makes you eligible for the WOTC credit. And as you can see here, a few thousand here, a few thousand there. It's almost like every time you hire people, if there's 10 people, at least one of these people is going to bring you a check for $2,400 or larger. So you can assume maybe about $240 times the number of new people you hire every year. If that's something you're not getting, it means it is something that you are losing. Not having what you should have is the same as losing. So one of the places you waste money is when you pay tax that you should not have to pay. This is not tax structuring. This is not changing from a C Corp to an LC. You could be an S Corp, C Corp, pass through, any kind of company you want to be, and be eligible for WOTC credits. You should at least be claiming them. So if you can't use them in a current year, you can carry them forward to the next and the next thereafter. But that WOTC is usually one of the top 5 that, unless you're a company of a very large size, you don't know about. And unless you're the size of Walmart, you're not even taking correctly once you do know about it. So the goal is not only to claim it, but to optimize it. It's not enough to say, oh, I did that. You have to optimize what you're doing. And most companies check the box, do it, and they think they're Einstein. It's not enough to say you are, quote, doing it. If it's not been optimized, I can show you how much money that you are still leaving on the table. And if you're not doing it at all, then by all means, you really want to get started. Okay, so that would be one of the...
I've had a number of business owners come back when I've mentioned things like this and say, oh, Paychex, ADP, they do that.
Yeah, they do it poorly. That would be the simplest way. Just add one word to that statement, and the word is poorly. I will give you an example. Talk to the largest franchisee of El Pollo Loco in the nation. So I have over 100 El Pollo Loco stores. Success story, to say the least. And then they've also got other names under their ownership. So I'm sitting down talking, and the CFO is a very sharp guy. He's very astute. And I mentioned WOTC. He goes, oh, yeah, we do that, blah, blah, blah. And I think one of the companies you just mentioned was doing it for him. I said, great, let's do the math together in our heads. You have this many people, you have a turn rate of this percent, correct? He goes, yeah. All right, that means you've got about 2,000 people that you hire every year. Times this, you should be looking at $400,000 a year in WOTC credit that you claim every year. Are you getting it, yes or no? He said, unlike most people, he said, give me a minute. Most people said, I'll look into it, which is another way of saying I don't want to think about it right now, and I never will. So he said, let me check right now, which, by the way, if you're trying to find out that one of your keys to success in life, whenever you've done anything successful, it's because you typically activated rather than procrastinated. So that to activate, not procrastinate, would be principle number one of anyone's life story and success. But in this particular case, he manifested. He showed. He said, "Yeah, let me go check." Wait about 2 minutes. Comes back, goes, "All right, I got the number. We're not getting 400,000. We're getting 40,000."
Wow.
40,000 sounds like a lot of money to a person who has no idea what he could be getting. When you don't know that 400,000 of opportunity exists, 40,000, you think you're crushing it. You think you're on top of things. But for every dollar he's making, he's losing 10. That's what he's telling us. Now, imagine somebody had said, Watsy just in general said, "Oh, no, got it covered." And that's how 99% of all companies lose money. The thing that made the CFO different, not only was that his intellect was better and his work habit was better, but he was a part owner of this large family-run company. He was the son-in-law of the founder. So
Wow.
he and his wife were shareholders. Now, nobody cares more about the owner's money than the owner does. And so another reason why all this money gets lost is because owners think that the non-owners care as deeply and fervently about their profit as the owner himself. This is a fairy tale. And we can either encourage people's fictions by saying, "Oh, yes, you have the best staff on earth. They work hard for you. They work selflessly. They have no other agenda." Or we can tell people the truth, and we can tell ourselves the truth. That is, the owners are on a different operating system from everybody else in their management team, including their brightest, most industrious people. The only way you can bring them into your operating system is if they are actual owners too. And short of that, there's got to be the assumption that no matter how hard people work, unless there's a third party outside the company, a company, again, like DCI, that does negotiation and audit from a basis of knowledge that most companies could never expect to have, you will always expect to lose money without fail. And that amount that you lose is, again, $1,000, $4,000 times your full-time headcount. So that being said, the WOTC is one of many types of tax credits, but it's the quickest one to check for because, one, you're either getting it or not. And number two, when you're getting it, you're either optimizing it or you're not, but we can quickly show you what you're optimizing or not optimizing. I would not leave it to ADP or Paychecks to do it. That's just simply a way for people to stop thinking rather than to think clearly. Okay.
Sounds good. What's number 2, Kirk?
All right. Well, let's talk about number 2. I'm going to go in no particular order here. Let's just see what comes up. Oh, here we go. So this is for a small business. Here's the dirty little secret. Do you have any veterinarians, you think, in your practice, Scott, or anyone that might be listening? If you do, great. They may want to raise their hand. But this is actually from a vet office in another state in the Midwest. Now, they're using a certain platform specifically for veterinarians. So it's a very good platform. They want to use it. A company called Covitris. And then Covitris makes a separate side deal with a well-known processor known as WorldPay. Some of your companies that are listening here, you might use WorldPay for your restaurant or for your shop or your professional practice, whatever it is. But WorldPay is the only provider selected to integrate with this Covitris platform that then serves all these veterinarian offices nationwide. So again, thousands and thousands of vet offices all using Covitris, all necessarily having to use WorldPay if they're going to take payment by credit card. And if you don't take payment by credit card, you're out of luck. So either you have a separate credit card processor, that just means more plastic on the desk. People don't want that, so they just integrate it all to Covitris, and they pay whatever WorldPay charges. So if the client sends us this 4-page invoice, and we come back, and the 4th page has got all these line items on it. This is stuff that no vet wants us to take time to figure out. So I put some annotations on the notes. Say, look, Dr. such and such, let me show you what's understandable here. There you got a 201, a 902, and a 759, meaning you pay every month $1,863. This 201 is a markup over what we'll call their baseline cost. That 201 really should be more like 150, maybe even 100. But 201, it's not going to kill you. It's not outrageous. It's just acceptable, but it can be reduced. So that's what we tell them about this 201. Then I say $902 is what we'll call the interchange. That's the baseline non-negotiable bedrock cost. The best example to liken it to is if you're familiar with how mortgages work, they might use a LIBOR index, right? And so a lot of banks will say LIBOR plus X percent. So this is the equivalent of LIBOR, but only for credit card processing. It's kind of that bedrock on top of which the banks and anyone else try to make their additional profit. So when we say this 902, we'll just call that's the cost of doing business with Visa, MasterCard. But then all these costs here that come to $759. I said these are garbage fees collected by WorldPay. I have no idea if they're paying a share to Cavitris. We would have to assume that's very likely, given the way business works. Why wouldn't it? But it's not necessary to know whether it's happening or not happening. All we know is we contacted the rep, and the rep's first response was, everything here looks normal. I don't see what the problem is. And then we came back and said, this is the problem. We want this to go lower. We want this to go away. Some costs are legitimate and can be reduced. Other costs are not legitimate and should be eradicated. Don't even talk about cost savings, just cost elimination altogether. So that email went out on, I think I sent the client the email summary on Wednesday. And then on Thursday, we said, here's where we need you to peel out this cost. And then the very next day, they said, I've been authorized to remove all these fees. It was that simple.
Wow.
So as a matter of fact, I may have sent you something. You can check it, Scott, called 3 Days to Save. I sent a short email to some people, and it told the story in just 3 quick sentences. Like Wednesday this happened, Thursday this happened, Friday, and everything got resolved. So all's well that ends. But that would be an example of a savings on credit card processing fees. Your clients, even if they don't have this 4th page here, where they can be auto dealerships, law firms, almost every company of any kind, white collar, blue collar, again, no collar, they are set up to take payments over the internet or in person or over the phone. And there are ways to reduce these costs. One of the simplest ways is through identifying what are called the level 2 downgrades, B2B level 2 downgrades. So for example, when it's not a consumer buying services for their dog like this, it's sometimes a business buying from another business. And that business to business transaction affects that interchange rate that we just spoke of. And here's what it does. It says your interest rate, your bedrock, your LIBOR equivalent, your bedrock interchange is here. But if you make a B2B transaction, then extra data fields have to be collected, like the zip code of where that company is located and a bunch of other fields. The credit card companies are very clear. We don't care if it's even accurate information. It just has to be populated. And if it's not populated, which it seldom is in a B2B transaction, now they're going to boost up that bedrock interchange rate, and it's going to become a higher bedrock number. So let's just say it's 1.75%, and now you've got B2B transactions, and there's that penalty, the downgrade penalty, when you do that and don't collect all that data, and 1.75 now becomes 2.2. And you just bump up. And so in those cases, it's not about negotiating a lower fee because the markups are almost immaterial. You want to get that bedrock rate down, that extra half bip, because if you're collecting, let's say, just $1 million a year, then 1% on $1 million is, if I'm not mistaken, 10,000. Every bip is $100. So if you've got 40 bips of increase, that's 40 times 100, $44,000 of unnecessary costs going out your window every year because a data field wasn't populated. Even if you got a great reduction on the markup, you're still paying that higher interchange cost that got inflated because you didn't populate fields when you did your B2B transactions. So far, so good, Scott?
That makes sense.
So auto pop is it's a somewhat clever way, I'll admit, of saying, look, you want to know what my zip code is? Great. It's 00000. Oh, good. Now that you told me, your rates go back down again. Is it that silly? Pretty much. It's
Wow.
not silly, but it works. And sometimes in life, the silly things work because we're subject to silly rules, right?
Yeah.
So that people are not doing. And so even if their markups are too high, if they're in business, their bedrock interchange rate is also too high. And so there has to be a solution that doesn't just negotiate a lower cost, but implements a very simple auto pop technology to reduce that. Okay.
So not
Now,
only is this reactive, you're not only just reacting to costs, you're also proactively showing the
yes,
client how do we avoid these costs in the future.
you have to avoid the iceberg, right? You have to say, why try to figure out how to save money on a life raft when we should just be avoiding the iceberg in the first place?
Right.
So if we can just move around this, then we don't have to worry about, some of the other things that come downstream for that. Okay. Now, the other thing you'd point out is people say, well, Kirk, I negotiate those things, blah, blah, blah. So if anyone wants to write this down, this is worth understanding and believing because this is how reality is. All your vendors smile when you negotiate. They are actually laughing at you behind your back because you negotiate. And by that, I mean the type A person loves to negotiate and hates to audit. So I was talking with one of our clients and I said, here's your savings on such and such. And the CIO said, that's impossible. I already negotiated that. I said, yes, you did. Now, negotiating doesn't mean it goes from the term sheet to the contract. But let's allow that in your case, it actually did mean that the term sheet made its way to the contract and the fine print. We should never assume that, but for the case of discussion now, let's assume you safely got around that hurdle that a lot of people don't clear and they end up losing money just on going from term sheet to negotiate to contract. But once you get the contract, people say, negotiate that deal. The client is standing on this side of the table and the vendor's on that side, and the vendor says, here. They reach out to the right hand and they give you all these discounts, all this money. It's like a bag of money. They just say, here. And the guy who's the type A negotiator goes, great, I did it. I am a genius. I'm the MVP. I'm the smartest, toughest, coolest guy in the company. I am the hot shot. Pop the champagne. Everybody celebrate me. And the vendor's smiling because he's going to give you with the left hand and he's going to take back. He's going to give you the right hand and take back with the left hand. He is going to say, yes, I know I'm going to give you this because you're negotiating. I also know that nobody ever gets sent every month a copy of a contract. Every month, instead of sending them a copy of the contract, they don't see the contract in the mail. They see an invoice in the mail.
Sure.
Who on earth should ever assume that the invoice is the same thing as the contract or that the invoice is always perfectly correlated to the contract agreed to? So I might agree to charge you $1 per.
Oh, did I lose you, Kirk?
Do you think the negotiator is even bothering to stoop down to the lowly task of checking? No. It's not in his nature. It's not in his temperament. He says, let Betty, the bookkeeper, do that. Well, Betty's not in the room. She wasn't there at the negotiation. She's not even sure she's understanding exactly how these cost drivers work. All she knows is that $1.15 is what it said in the previous month. And I've got all these bills to pay. I got to get them out on time. If I don't, people start hounding me, make my life miserable. Plus, it's not Betty's money, is it? Betty, the bookkeeper, whoever's doing EP, she's not spending her own money. So Scott can tell all the people that he has as clients, two groups of people in every company. What are those two groups? The people that own the money, the people that spend the money. And there's a lot more people spending than that single person who is owning. And if Betty's under time pressures, she gets those invoices paid. And this is how the left hand of the vendor takes back whatever might have been conceded with the right hand. Does
Actually,
this happen? Go ahead.
let me ask that question in a different way then, Kirk. I asked about the question in the sense of going forward. What about the other side is when you go and you're doing these negotiations, are you ever able to claw back past payments? Like in the
Yeah.
case of the vet with their credit card bill, is there
Yeah.
a way to go back and say, hey, we've been overpaying fees for the last 12 months? And if so, how far back can you typically go?
Sure. So I gave the example of one surfwear company that's here, a different surfwear company, but also in Southern California. That same one, actually, now that you mention it, that same one that's where the CIO said, how could that telecom contract be so high or that invoice be so high? Because I negotiated myself. That same company, even though that was nice that we got that cost identified, and we did recover the past 7 months where they had been overcharging and fixed it in the go forward. The real money was saved in their real estate. So, true story. They did tenant improvements, so TI allowances. Some of your clients get a TI allowance when they build out a new office or a new
Sure.
retail location, right? So the landlord will often give the TI allowance in fractions, right? They'll say, "I'll give you a third here, a third here, a third, so many months or so many days after completion," right? So when you're opening and expanding, people know that at some point the mind of the people on the project turns to the next battle, the next major project. So we looked 7 years back on this is a CAM for a coffee company, but we did a CAM audit for this company. And we said, 7 years ago, you awarded 2 of the 3 TI allowances, and the third was never given to you. Really? 7 years ago? I said, yeah. We'll talk to the landlord right now with your permission. Yeah, sure. Go ahead. Talk to the landlord. See what's going on there. And the landlord's response, because it was over $100,000, was, I was just waiting for you guys to come. He was basically saying, I knew that you guys didn't get that 100,000.
Seriously?
And seriously, I was just waiting for you guys to come. Now, he knew that after 7 years, they weren't going to come. What he meant was, all right, I could use the 100,000 month, 2 months, 3 months, 4 months, but at some point, it's clear the client's never going to think about, because they're already on their mind on other things. People forgot what was
Sure.
negotiated, the TI allowances, right? You just move on. Who's going to audit this? It's just too painstaking. It takes too much mental energy. If you want to know if your employees are out of mental energy, ask them how they're doing, how their day is going, what's up, how's it going, and they'll always give you one word, which is busy. Busy is code for I have no mental energy. I am out of energy. I'm out of bandwidth. Do not ask me to do one more thing, think one more thought. I'm exhausted. So when I speak to companies, it sounds like I'm saying that DCI is offering you money. I am not offering you money. I'm offering you energy. The thing you lack more than money and time is energy. The thing your whole organization lacks is this energy. You have to be infused with an outside motive in order to keep track and to track down these dollars that have been pilfered, siphoned out of your company. And the landlord is just one of many examples. He says, yeah, I knew about the money. I figured, keep it until you ask. If you're not going to ask, why should I kill myself to tell you? Right? So this is why companies lose money, because they're dealing with other companies who want to make money, sometimes at your expense and not ethically so, right? So they'll say, well,
Okay.
if you paid me by mistake, you can come back and get that money when you ask. And if you don't ask, then that's not on me to track you down for your mistakes.
All right.
Or
So
if I owe you money and I forget, it's up to you to track me down, right?
So then DCI looks forward, but they also look back. All right. So let's move on. We got about 20 minutes left. Let's move on to the third issue. What's our third one, Kirk?
All right. Let's see. I don't even know. Okay, here, payroll processing fees. That one's almost too boring to talk about. Let's look at another one. Here's one. Freight. So we had send this email to a client. FedEx agreed to lower rates, and things are going great for multiple years. As a matter of fact, here's the email. Please see below the information that we have. In the old agreement, the earned discount tiers were lower, so blank was getting better rates. So we took out the name of the company. Blank is currently spending $300,000 a year, which in the old agreement would have maxed out your shares at a 12% discount. but in the new agreement only meets the 10% discount. Below is a screenshot from the agreement we have. And so we just demonstrated here. Look, see, you got an earned discount of 12% once you get to this level on FedEx 2-day, blah, blah, blah. And the new agreement highlighted in yellow, if we look very closely, you see the number 10. That's where they are at that $360,000 mark. So what happened was the client's going along fine. Somewhere along the line, somebody in the warehouse must have had lunch with the FedEx person, and the FedEx person said, oh, here's a new agreement, by the way. Do you mind signing this? Oh, sure. He does a renegade signature. CEO doesn't know, CFO, COO. None of the people in freight even knew this had happened, and they didn't even know that they were losing money. So DCI, every month, looking at the invoice, and we're saying, here's where they forgot to ship or did not ship on time by 11. You're owed this many credits. And so, yeah, maybe $600, maybe $1,000 every month in credits. By the way, if the CEO owner of a company is shipping hundreds of thousands and doesn't have a monthly credit report, it's because he doesn't have anybody auditing. He has his warehouse manager, his COO negotiating and losing money for him. Because you should have a roll-up report pushed to you every month showing that we contacted FedEx. Here are the dollars that you saved. Even after the rate is negotiated, there are credits that are to be claimed every month.
Wow. But
in this case, he wasn't aware that, one, somebody else had signed a new agreement. Two, that whoever signed this agreement basically nullified it's been almost 90 days now of savings. He's gotten zero savings for the last 90 days because he's not been able to track down who did this, why they did it, or get the FedEx to remediate. And he wants to be lead, so we're not being the bad guy with FedEx and being, playing the bad cop. But clearly, some chicanery happens in every company like this and goes undetected unless there is somebody who is watching. People have children and they have nannies that they love, but people have nannies and they also have something in their house to keep an eye on the nanny cam, right? Sometimes they hide the camera inside the wall or in a picture or in multiple rooms so they can see the performance of that nanny that they trust with their child. It doesn't mean that they don't trust, but trust but verify is the only way to protect the most precious things in your organization, whether it's your baby or if it's your company, it's your money. So people that don't have this think that trust is all they need, and they will end up losing because they're not taking enough diligence to at least outsource the audit. They're simply saying, well, trust the people that negotiate. So those things definitely are, see, we covered freight. Oh, we didn't get to health insurance, did we?
Not yet. We'll get there.
Oh, all right. So let's see if we get to health insurance. Let's give you a real life example here. I don't want to hurt anyone's feelings or step on anyone's toes. Some broker who's really fairly well regarded saw one of my guys took some of DCI's work and he showed it to the guy and he took offense. He was like, who are these people? We're the brokers. This is an honorable profession. We work harder. Nobody knows more. How could I trust any company like this to ever help my clients? And the answer is going to be visible right now. This is on the left in red. It says renewal rates. So think of a platinum quality plan, a PPO like a Blue Cross or a United, Cigna, Aetna, one of the majors. And then think of a ultra low deductible, like say $500 deductible for an individual. Okay.
All right.
It's got a deductible. So put that in mind. So that kind of very low deductible, which usually when you've got a company of white collar attorneys, doctors, people that are making $100,000 a year or more, they don't want to buy your Kaiser HMO. No, thank you. That's not going to flush. They may not mind. Then they come on to their wife and their wife says something that makes them go back to the boss and say, we're not taking this plan, right? So they inevitably have to make sure that the family is covered, even if the individual doesn't care about his own particular benefits. So in this case, think about a $500 platinum quality PPO, all the bells and whistles that you'd offer to your most highly compensated employees. And the family rate, in this case, is what you see here. And we're saying to this client, you can duplicate the quality of that plan. And you can, in this case, Blue Cross network, stay with Blue Cross. Don't leave Blue Cross. Same doctors, heck, same network, same everything. And now your monthly premiums for, as you can see, because they had 13 individuals, 4 with a spouse, 3 with a child, 12 with families. The monthly premiums dropped from 68 grand to 36,000. About 40 something % reduction in cost. One of our clients did this, and his broker came back and said, "All right, I've got the rates for you now." And the owner of the company, is about 50 some odd employees, said, "No, thank you. Appreciate you coming in. Appreciate you being our broker all these years, but this is far higher than we're going to pay. And we're not leaving Blue Cross, but we are no longer going to be paying these rates." And the broker said, "Well, that's impossible. You see, there's only one rate. You just have to choose the broker you like. So are you saying that you like someone more than me?" He said, "No, you're great, but there's a significant dollar difference." And he said, "How could that be? This is the broker, full-time living, doing this. How could that possibly be?" And the owner said, "Can't tell you. I'm under an NDA with it, DCI Solutions." And it ended there. So the broker walked away scratching his head. The client walked away with a ton of money. So you can be one of two people. You can be the guy scratching his head saying, "I don't know how they do it, probably a fairy tale, probably on LSD," and act like that conversation never happened. And that's what many people are content to do. They say, "Sounds too good to be true. Had to be a come on, had to be a pitch." Great. You can scratch your head or you can have more scratch. And that's exactly what this client is looking at. They're looking at a dramatic reduction in cost. And they know exactly how it worked because they're in an NDA with DCI. I will say the stuff that looks like magic, it always works like science. And if people are making one huge mistake in life, it's that they are trusting the broker to be their analyst. A broker is a commissioned salesperson. No offense. But you don't pay your broker, so to speak. Blue Cross, Blue Shield, United, Cigna, Aetna pay your broker. You find a broker that you can enjoy, just like in a restaurant. You find a waiter that you enjoy. But your waiter ultimately works at the pleasure of the owner of the restaurant, not you. So he will do everything he can to keep you. And then, of course, the waiter, if you go into the back room of those restaurants, and I used to work in a restaurant, I know this from college days, there'd be a board saying how many alcoholic drinks were upsold to, the patrons on a given night, and which waiter had the largest number of upsells. And then they were incentivized and bonused by the owner of the restaurant. So when people say, "Well, what do you recommend?" The waiter's thinking, "Well, I'm going to recommend whatever gives me, my own financial consideration." People say, "Oh, I didn't know that's how it works." That's how everything works. That's how your company works. You do that with other people. Why would you think people aren't doing that with you? We all do this. We're all motivated. Nobody wants to work for free. No one says, "I'm going to work in a way that actually reduces my paycheck because I care about the client so much." And even when people make these minor sacrifices, they're never a sacrifice that takes the client's cost from this amount to that amount. One, the commissions are dropped. Number two, even if you're motivated, you'd have to know how. And most companies don't know how. People that sell don't know how to unsell. Second, if I can give a different example from this one, this is a company in Illinois. It's a brokerage, paying $2.1 million in premiums. And we said, "Look, this 2.1 will become 1.5. The owner is the one taking the meeting. He did not say, "Cover this with my CFO." What does the CFO care? He cares somewhere between 0 and none about the owner's money. But thankfully, the owner was in on the meeting. He said, "All right, I barely understand how insurance works. Tell me how this works." I said, "Here's how it works. Now you can invite your corporate controller to join the meeting now that you know that 600,000 saved." He said, "Great. Now let's get the broker involved." So today's meeting was with the broker. And the broker was very eager, saying, "Oh, yes, yes, there are things we can do. We can do this, 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 this." And he's coming up with about 50% of all the ideas that the owner already knows about from DCI. We're not telling this broker what else we already know. We're letting him show us what he knows. And if he says, "Hey, I got a quote here, quote, great." Because I'm not going to pick up the quote. I'm not a broker. So the broker ultimately has to get the quotes, some broker, but it doesn't have to be one particular broker. And then we come back and say to the client, if we execute this strategy, here's the additional money. And we'll take it from the amount that the broker said he could get and get that extra amount. So again, it goes from 2.1 to 1.5. But which broker he uses, he's now got his current broker that we talked to this morning, and tomorrow we talk to an alternate broker that he golfs with. But there could be a third or fourth broker. It won't matter. I'm not brokering. I'm simply telling the client, this is the strategy. This is how your money works. This is how to get your money back. And you can have as much of it as you want all day long without fail. But yes, companies lose money, one of the first 5, because of trusting a broker. Now, Scott, no, I don't want to hurt anyone's feelings, but if I may slip this one in, who is typically in charge of a company? If now we get a larger company, let's say 50, 80, 100 people, that company will typically have an HR person, right?
Sure.
At some point, when you get close to 100 people, there's an HR director. Scott, you make your living with numbers. You translate dollars into meaningful events in people's lives. So I'm just going to try and get fuzzy here, but that's the way it is, right? So there has to be a numeracy that you possess, along with some great people skills that you also possess, right?
Sure.
Now, let me ask you, when we talk about HR people, they have great people skills, undoubtedly, right?
Yeah.
What about their numeracy?
It varies from.
It varies, but I will be honest and blunt. Mr. CEO owner of this company, your HR person is the least numerate executive you employ.
Usually, yeah.
Sometimes you could add up the number of business course of degrees they have in finance, and the number of degrees they have in finance is somewhere between 0 and none. And then you add up all the courses they had in advanced mathematics in college, and that total of advanced mathematics beyond bonehead basic calculus is somewhere between 0 and none. And now you're giving a person with very low numeracy responsibility for one of the largest line items in your budget. What's wrong with this picture?
Yeah.
Right? So this is why so many companies lose money, is they've said, it's a headache. I don't understand it. It's like black witchcraft, magic voodoo. And because the owner doesn't want to think about it. Remember we said that if you don't want to think about things, you'll continue to lose money. If you're teachable, I can make very complex issues very simply understood quickly by an easily distracted business owner. And then once you understand how much money is at stake, then you can decide to have it if you'd like. But you should not be relying upon your broker, and you should not be relying upon your HR person for analysis, because quite frankly, your HR person simply says, broker, make my enrollment easy, and you'll keep this job forever. Be nice, pleasant, take me out to lunch once in a while, and make my enrollment easy. Be like outsourced staff to me so I don't have to work as hard or be stressed out during the enrollment period. And then they keep the broker. And this is how your company loses the largest amount of money I think we've ever saved per employee has been $10,000 per employee per year on their health insurance. This example here that you see, the company with 31 people is saving $180,000, so about $6,000 per employee per year on health insurance. The largest we've ever done is $10,000. It's almost too easy to find health insurance in about 50% of all the companies that work with. The other 50%, there is no savings. And that's why I don't have just one dashboard dial. That's why there are 9 dashboard dials. Because with this, it's like saying, will you catch fish if you have a net that's 20 miles wide, 20 miles deep, infinitely strong, and you drop it in the Pacific Ocean and overnight bring up the net? Will you have fish? The answer is yes. I don't know where, but I can tell you that the number of fish inevitably will be a ratio or an amount of $1,000 to $4,000 for every full-time employee you have in the company.
All right, Kirk, we've done 4. We've done 4, and we got 5 minutes left.
Oh, gosh, we're running out of time. Oh, let me do telecom. Here's a funny one. Sometimes it helps not to buy direct. Do not buy AT&T direct. So we had a company in Oklahoma and they had contracts with AT&T. We said, look, why don't you keep the AT&T network? You know, your engineers, they like the AT&T network, but what if you could buy the AT&T network, but buy it through ACN? What's ACN? ACC. ACC is one of the three major resellers of AT&T, and they have a lower authorized rate of return on their sales force than AT&T does. So that means that for the exact same thing, you say, I'm going to go to AT&T direct, get it for 1,000. You go to ACC, you get it for 700, 800, you know, like 20, 30% less for the exact same thing. I won't go through the examples, but that would be example one. Example number two of going indirect, going through brokers, not just for telecom, but in this case here, this is for a waste disposal bill for a hospital. We said, we're not going to go through this company direct. We're not going to go to Allied Waste direct. We're going to go through a broker. And I remember the CFO and the attorney for the hospital said, that doesn't make any sense going to a broker. We always pay extra if there's a middleman. No, that is not always true. The things that you think are true, the goal of learning is not really to learn, but as one person pointed out, the goal of learning should be to unlearn, or the goal of teaching instruction should be to unlearn things that you thought were true and really aren't. And one of the things you think is true is that middleman always adds cost. We said in this case, you actually get lower rates buying indirect than you do through the direct channel. So indirect channels, whether it's telecom or waste, that's a twofer. I'm trying to put two in one.
I get you. But, indirect channels, though.
Yes, indirect channels. So sometimes a different channel, sometimes an indirect channel. Direct channels make a lot of sense at times, but not always. Okay, so those are the top five, and I think we've got 3 minutes to spare if there's any Q&A.
We don't, but what I would prefer to see us do is give us the recap of all five now.
Wow. I was talking a little bit in stream of consciousness.
So we talked we started with WOTCs. So WOTC, we started with sometimes it's just the straight up employees and making sure that that just recognizing that sometimes our payroll or servicers aren't doing, you know, the job that we suspect that they're doing because we don't know what we don't know.
Right.
The next one you talked about was WorldPay and just the credit card processors. And there, the moral of the story was basically, hey, sometimes there are charges that just should not be there.
Mm-hmm. Right.
The next one was the real estate example where an agreement was agreed upon. Mm-hmm. And then you need to make sure someone's going back and looking at the agreement and comparing it to what's
CAM audits, right? Things like CAM audits, exactly, right.
Apologies. After that was the fourth one, the brokers. The brokers are not always the brokers aren't always the best informed. Sometimes it really does help to have that person who is highly efficient at just Blue Cross and knows where all the little rabbit trails go and all the depth that goes into the pricing of particular services that you receive and can really net you a huge benefit. And then our final here one, our twofer, was sometimes, while at times brokers don't offer the best solutions, sometimes they do. And just what you said, sometimes unlearning and making the assumptions that this one idea that brokers are just an extra cost isn't always correct. Sometimes those brokers are able to negotiate far better rates for the end user because essentially let's just use Allied as our example. Allied Waste Management probably picks up some efficiency by just working with the broker, having them do all the servicing, and then all Allied has to do is just pick up the waste. Yeah.
So there's a lot that we're not covering here, but the broad understanding that we covered, I think, is enough for people to at least be reasonably suspicious that there's no room for complacency, that they got it covered. Okay. It's very possible to be under budget and overpay. So if your people are saying, Scott, I'm under budget and we had a great year financially, great. You can be under budget and overpay. And not only can you be, I'm going to submit humbly that you definitely are. Somewhere in this dashboard, no matter how under budget you have been and how profitable you've been, the amount of money that you've been overpaying for every employee is somewhere between $1,000 to $4,000 of additional money that's not yet being realized by that owner who works really hard to create something that he calls his company.
All right, last minute here, Kirk. Let's ask the one last question. If I'm a business owner, how do I know it's time for me to reach out to Kirk? What are the parameters of the business? How many employees? How much?
If you've even got 10 employees, I promise to give you one of the most enjoyable 30-minute conversations you've had in a while.
Perfect. 10 employees is kind of our baseline then.
Yeah. Let's start with that. You got 10 employees. You got 8 people, but you got a $400,000 freight bill. I'd love to talk with you. You could be each, right?
Which is possible. That's true.
Yeah.
So if there's one very large expense that kind of makes up a huge portion of your business, that's a good time to talk to.
Yeah.
All right. Well, everybody, this was Kirk Connolly. Again, it's DCI Solutions, and his website is dcisolutions.net. A great website, by the way. Really like the application of it, Kirk. Kirk, thank you again for coming in and speaking with us. This was really informative. I think there's a lot of, especially if there's a recession coming, cost has got to be in the forefront of people's minds. And so wish you a great 2023. Glad to hear you had a good 2022. Everybody, thanks for coming in. We look forward to seeing you again in our next show that'll be coming up in the beginning of the new year. Take care, everybody.
Thanks.
Thank you again, Kurt.
Thank you all. Bye-bye.
Bye-bye.